What they might do is sell their treasuries, as I've said before, and cash it in, take those dollar deposits and sell them versus the yen, to buy back the yen, to try to stabilize it. I don't think that will work, this intervention. They've tried it. As I said, they have to raise rates, but they can't. So this could, coupled with this October surprise that I see, create major disruption, not just in the US and Japan, but throughout the Western financial system. Wednesday, July 3rd, 2024, Maneko 64, home of alternative economics and contrarian views. Today we're going to look at the bond market again. We're going to look at Treasury yields and how I think we could be in for a surprise this October in terms of the move in Treasury yields. And looking at that, I'm going to talk about how that could affect the U.S. banking system, and in particular, the unrealized losses that are held to maturity by U.S. banking institutions. Before we go further, though, I'm going to do something a little different today. I'm going to give you a quote from Alexis de Tocqueville. He was a French aristocrat, diplomat, sociologist, political scientist, political philosopher, and historian. And he's best known for his works, Democracy in America and the Old Regime and the Revolution. And someone tweeted this out yesterday or posted on X, and I thought it was very appropriate quote by Mr. de Tocqueville, especially with what's going on in the political sphere and economic sphere in the West. And this is what he said about democracy. It can only exist until the voters discover that they can vote themselves largesse from the public treasury. The majority then always vote for the candidates promising the most. A democracy always collapses over a loose fiscal policy. So there you go. What's the antidote for a democracy? I think it's a constitutional republic where the rights of the individual, not of the majority, are protected. And that's what the United States of America is supposed to be. But of course, that has been diluted and it's become a democracy. You hardly ever hear anyone talking about the United States of America being a constitutional republic. So yeah, that's my quote of the day. And yesterday, I went into town, into London, and I visited with Oliver Temple. Mike Temple was there, and also Oliver's son, who's working with them already. So it is a family-run business. And Christopher, one of the viewers, sent an FT, an old FT, a weekend FT, from 1999, and I'm going to talk about it, and I'd like to thank Chris, and it's about gold, and specifically during the time that Gordon Brown was selling the UK's gold, and it says, is it time to bury gold? Gold was at around $250 an ounce at the time, so that's very interesting. I'm not going to cover it in this video, but talking about gold investments, we've got a new special at Gold Investments, and it's to do with silver kilobars. It might not be this kind of kilobar. It could be others, but they've got a 5% discount off the price on the screen that you see if you use the code Maneko64KG, as in kilogram. And they have other specials as well, as you will see in the description. And if you want to buy other stuff that's on special, you got to do it separately, the purchases. but the system will add everything up, but you can't put different codes in the same purchase. You got to do it separately. So yeah, check that out. And also I see that Miles Franklin in the US, my US precious metals affiliate, they've got some interesting specials this week. A tenth of an ounce 2024 American Eagle, only $39 over melt. And they've also got 1 ounce silver American Eagles 2024, $5.95 over spot. So all the details are below in the description of how to get a hold of Miles Franklin. Make sure you mention Monaco64 or Mario. So I was looking at some charts yesterday of the 10-year yield. And a lot of you, of course, know that I worked in the bond markets for over 20 years. I was a futures and options broker for institutional clients. I started out in Switzerland, and then I came to work in London. And I did a lot of technical analysis aside from fundamental analysis. And one of the reasons I started this channel back in November 2015 was that I wanted to talk to the general public as I used to speak to my institutional clients. And by institutional clients, I mean fund managers, treasurers at big corporations, treasurers at banks, and even other brokers that had to use the companies that I work for. And every morning I would be calling my clients to tell them what was going on. And I thought, this is what I'm going to do on my channel, but I'm going to do it in a way that I explain it to the layman what's going on in the financial sector, in the monetary sphere. And I've added, of course, I use a lot of history and books to try to see what's going on and what could happen in the future. And yeah, so I've been of the opinion that ever since 2021, the bull market in bonds that started in 1981 was over, 40-year bull market, which meant, of course, that since 1981 until 2021, the trend for interest rates and yields were always lower. Yes, you had some bear markets in the bond market along the way where yields went up, but it was always a lower high and a lower low in terms of yields. And that's what built up the everything bubble, because it always costs less to refinance. But as with everything that's really good, it doesn't last forever. And yes, I've been saying that the bond bull market is over and it's going to be a difficult period. Could it last another 40 years, just like the bull market lasted? It's possible, but one thing's for sure, I think yields are going to continue to go higher. And so I looked at the US 10-year yield, which is really the benchmark for the whole world bond market, global market. And it affects everything from other government bond markets to mortgage-backed security yields, mortgage rates, corporate rates, everything, the cost of borrowing. And I found something interesting. In the last 3 years, if you look here at this chart, and it starts in the summer of 2021, yields picked up from around just over 1% to just under 1.75% by October. Yes, it sounds really low, but considering the 10-year yield got to like 0.3 in 2020, yeah, it was starting to move. So keep that in mind, summer to October. And of course, after that, it kept really going higher, which was a problem, of course. But then next year as well, if you look at from the second red arrow pointing up, around summertime as well, yields started going even higher from just around 2.5%. All the way up to just below 4.4%. And that was by October. And what happened in March of 2023, a few months later? Well, a lot of big money, especially at Silicon Valley Bank, started worrying about the unrealized losses held to maturity by banking institutions. And they started looking, of course, at each individual bank's balance sheet and the footnotes, and they realized that these held to maturity unrealized losses might have to be sold or become available for sale at a big loss. And why is that? Well, because a lot of these banks were holding Treasury securities. They were holding mortgage-backed securities. And with yields going up, the value of all these securities was going down. And these securities are the bank's assets, and the liability to the banks are your deposits. So when depositors, especially at SVB, people that were Silicon Valley billionaires, seeing this, they panicked. And herein lies the problem. And this is when unrealized losses held to maturity becomes an Achilles heel, so to speak, for the banking system, is when the smart money starts seeing that bond yields are going higher, and that and then they panic and they transfer, they demand their deposits back, probably not in cash, but they just transfer it to JP Morgan or a big bank. And of course, the big banks, recently I spoke about it, the Fed and the FDIC said that they haven't done their due diligence in terms of their wills properly because of derivatives. So you can see how it can become a problem. And looking at this chart from the FDIC, it's really worrying, as you can see. I mean, these losses are humongous, even compared to 2008. And this is where this October surprise for me is really serious. And if we go further into late 2023, you can see that the same kind of pattern and cycle happened from the spring up until October. Yields went up again, and we got up to 5%. And then, they've stabilized since then. And they've started to go up a little bit right now. And they could still go down a bit further because, it doesn't necessarily mean it has to start going up. But I think what we've seen in the last 3 years could happen again into October. And we could see the 10-year yield break the high from last year at 5%. Where could it go? Well, it kind of depends, because if we see it drop again in the next few weeks or next month, let's say it drops to 4%, the move in October could be, let's say, to 5.25 or 5.5. But if it stays up here and keeps going up in October, we could even see 10-year yield at 5.5 or 6%. And I'm not saying that it would cause havoc already in October, but it might, because back in 2022, it took a while for big investors and the big money people to realize that these held to maturity losses were a problem. It took until March. And of course, these FDIC numbers, they come out like about 55 days after the end of the quarter. And at the time, no one watched these FDIC numbers either. But now the whole world's watching it. So the October surprise might cause actually some kind of crisis even before next year, even before the election. So I think we need to keep an eye on that. And that would mean that the Fed would probably not be able to cut rates this year, and that inflation would remain sticky. I saw that Jay Powell was in Frankfurt. He's been in Frankfurt this week. Another freebie for central bankers at the ECB. And he said that we might get to 2% CPI target, or I'm not even sure if it's the PCE. He said it could be by the end of next year or the year after, so 2026. So, it looks like the market itself is saying they don't believe the Fed has done enough, and that inflation's still a problem. So let's quickly look at the markets then this morning. So it's 8:24 a.m. London time. Rudy and I have been for a walk this morning already. It's a little drizzly, but I think it's going to stop. It's going to be a fairly nice day today. But anyway, let's start with gold and silver, as we always do. So we've got spot gold at $2,343. That's up $14. The high's been 45 and the low's been 26. So gold's doing fairly well here. I did a video on Saturday, I'm going to put it up in the cards, about seasonality of the gold market, and I think you'll find it interesting. Spot silver is trading right on the highs here. It's up 45 cents or 1.5%, just below 30. We're trading $29.97. The high's been $29.99. By the time you listen to this, we could be above 30, or the cartel might have come in and smashed it down to 29. Who knows? Anyway, I'm still very positive about gold and silver. And why is that? Well, because I'm very negative about fiat currencies and the bond markets. And we're going to come to the Japanese yen and the JGBs as well, the Japanese government bond market. What about the stock market indices? Well, the Dow futures is up 27 points. The NASDAQ 100 future is down a little bit here, not much. And so is the S&P, not much to write home about. The currencies are pretty steady, excuse me, with the exception, of course, of the yen. The dollars continue to make new multi-decade highs here. We're at 161.88. The high's been 161.95. And why is that a problem, the weakness of the yen? Well, because the yen has, for the last couple of decades, provided a lot of liquidity for the whole financial system in the West, not just in Japan. And what's going on now is that the Bank of Japan is between a rock and a hard place. Japan has over 250% public debt to GDP. I know half of it, more than half of it, is owned by the Bank of Japan, and a lot of it is owned domestically, but Japan has a problem because their currency is dropping very sharply. And what can they do to stop that? Well, personally, I think they should start raising rates. But the problem with raising rates is that the debt load that they've created becomes unsustainable. And it's the same problem, of course, for the United States. And that's why it's so serious, this October surprise, especially when the U.S. Treasury is running trillion-dollar deficits, or the debt increases $1 trillion every 100 days. It becomes a problem, and I think it will become a problem. And that's why Gold and silver are continuing to go higher despite higher yields. And we're seeing the JGB yield, the 10-year, now at 1.1%, which doesn't sound much. But until 6 months ago, it was around 0.75. About a year or 18 months ago, it was near 0%. So I think they've got a big problem. And Japan has big holdings of U.S. treasuries. So what they might do is sell their treasuries, as I've said before, and cash it in, take those dollar deposits and sell them versus the yen, to buy back the yen, to try to stabilize it. I don't think that will work, this intervention. They've tried it. As I said, they have to raise rates, but they can't. So this could, coupled with this October surprise that I see, create a major disruption, not just in the US and Japan, but throughout the Western financial system. And that's why I think it's more important than ever to have some physical gold and silver outside the system. I think things are going to get very interesting very soon. So there you go. Anything else? Well, let's quickly look at the U.S. Treasury yields. Yes, they came off yesterday. On Monday, they've gone up to almost 4.5%. As I said, they can still come down a little bit in the next few weeks or next month, but I see them a lot higher by come end of October. Right now, we're unchanged at 4.44, so there you go. And yeah, with that, I'm going to wish you all a very good day and talk to you tomorrow. Take care. Bye.